Welcome everyone to Blackpoint Capital Partners January market recap for the year of 2026. My name is Nicolas Mauricio, your host here at Blackpoint Capital Partners, and today we'll be covering some of the latest developments in growth, policy, rates, and markets. I'm also joined by Arun, Kaul, Chief Investment Strategist here at Blackpoint Capital Partners. Before we get started today, this presentation is for informational purposes only and should not be considered investment advice or a recommendation for any specific product or strategy. Please consult your financial, tax, or legal advisor regarding your individual circumstances. For today's agenda, we will be covering the economy, U.S. economy specifically, policy, fiscal tailwinds and investments, rates, Fed watch and inflation outlook, and equities for the market rotation in some of the software sector as well. Over to you, Arun.
Hey, Nico, thank you. So just to start with, we'll take a look at U.S. economic growth. Of note, the estimate for Q4 is running above 4%. The actual growth for Q3 was also above 4%. That's important because the U.S. has not actually had back-to-back growth quarters above 4% net of the COVID period since 2014. So it's been over 10 years. And then prior to that, it was in 2003. So it's not a very common occurrence for the U.S. economy to grow above 4%. So strong U.S. growth, we think it can continue in part because of a tremendous amount of the policies being pursued by the administration.
Perfect. And Arun, so just to dive into that a little bit more, so policy support, is there anything else that's driving growth and something that we can see for the Q4 numbers that might be coming out here shortly?
So you're certainly seeing a tremendous amount of investment in the U.S., a big CapEx spend from software companies, from cloud computing companies, and from the entire AI stack in terms of infrastructure, build out, and technology. So that's certainly been one of the reasons. And you're also seeing some support from energy and materials as well.
Great. Speaking of policy support, let's look at what's happened on the fiscal side of things. Can you talk to us a little bit more about that one there, Arun?
Yeah, so part of the strength this year is that the legislation, the one big beautiful bill that was passed by Congress, certainly expedited tax and depreciation for corporations, pulled the entire depreciation forward into year one. That allows corporations to invest in plant, equipment, and infrastructure and write off the entire 100% of that investment within year one, creating a significant reduction in their taxes. There was also benefits on full R&D expensing. So those two are definitely helped to pull corporate activity and CapEx forward. And in addition to that, there have been a tremendous number of executive orders that are focused on energy, on materials, on energy infrastructure, on data centers, even on reducing some of the regulations in the EPA. So what we're seeing is a pretty big push to reindustrialize or bring back investment in the U.S. and to also reduce as many of the regulations as possible to encourage investment in the U.S., both domestic and foreign.
And how does this compare to previous cycles? Obviously, this is the OBBA is relatively new, but can we compare this to previous cycles in the past, or is this new territory that we're heading into for 2026?
Yeah, it's a good question. It's really a reset of the post-2000 environment. 2000 is when the Chinese economy joined the WTO, and they were very aggressive in their footprint in terms of aiming to be a net exporter, and certainly benefiting from labor and wage arbitrage against Western economies. So the U.S. is attempting to do a reset and really look for more manufacturing and industrial production to happen in the U.S. and much less overseas, and certainly be much less reliant on China. So I think it is a reset of the past 25 years to try and have the U.S. be more self-sufficient, or at least hemispheric sufficient in terms of production, manufacturing, and overall GDP growth.
Great. Now let's go ahead and turn over to interest rates and what the Fed might be signaling moving forward. We've obviously got a new Fed chair coming in with a recent appointment. How does that affect things? Can you talk to us a little bit about what that might be, Arun?
So the challenge we have is we've just gone through a period where we had the highest inflation. We got as high as 9%. which was the highest inflation in almost 50 years, going back to the 1970s. So we've now been above the Fed target, which is 2%, for 5 years. So they've been offside for a full 5 years. And right now, inflation is proving to be a little bit sticky in coming back to the Fed's target of 2%. So interestingly enough, the real-time metrics are showing inflation around 1%, which is from Truflation, but the actual numbers that the Fed looks at are around 2.4, 2.5, a little bit higher up to 2.5 or 2.6, depending on which metric you're looking at. So there is room for rates to be cut on the short end, but I think we have to keep seeing progress on the inflation front. I think 2 cuts this year, which gets us towards 3, is certainly doable, assuming inflation is in that 2 to 2.25 range.
Great. Before we get on to obviously the inflation and interest rate outlook, the main question everybody has is, how does the recent appointment of Warsh affect anything, if at all? Do we see that potentially changing the Fed's approach? It's also talked about quantitative easing and how that might change moving forward. Is there anything that you might want to potentially comment on that side there, Arun?
I don't think it changes the overall Fed policy, which is to focus on its long-term inflation target. I think the Fed might be a little more flexible, and there certainly might be a little bit of a harder look at the balance sheet and less aggressive use of the balance sheet by the Fed. There's certainly been a tremendous amount of distortion in Fed policy in the last 15 years post the great financial crisis. I think you'll also see a little tighter coordination between monetary and fiscal policy. I don't think that's a bad thing. The Fed can still be independent and accountable, but still also coordinate in terms of the U.S. government having a consistent policy towards the overall economy.
Great. And speaking of inflation, which is the hot topic over the past 24 months, what does that look like? You mentioned as well, real-time data suggests potentially 1%. Can we dive into that a little bit more, Arun?
Yeah, so on the left-hand side is the inflation outlook from the market, and we've been running pretty consistently between 2.25 to 2.5%. So above the Fed target, and right now we're at the higher end of that range, which is about 2.5%. So that makes it a little harder for the Federal Reserve to be aggressive in cutting rates if the expectations for inflation are running at 2.5%. The Fed does look at market expectations for inflation, and there's a little bit of a circular argument or a little bit of a circular flow in terms of how the Fed looks at inflation expectations and how the market looks at the Fed to set its inflation expectations. Regardless, at 2.5% is a little above where we'd like to see it. And we see it move back to 2.25, then that does give the Fed room to move towards 3% on the short end. On the long end, the graph on the right, which is the 10-year Treasury, has been very stable between 4 to 4.5 over the last 2.5, almost 3 years now. And if we have a 4-year rate on 2% inflation, that's about 200 basis point real return. That's reasonable. That is equal to the long-term average over the last 30 years, but the long-term average has quite a large variance around it. But I think 4 to 4.25 on 2% inflation makes sense for the 10-year.
Perfect. And does that mean we're into that maybe Goldilocks scenario, right? Are we seeing inflation concerns, or do we potentially think there's any potential recession concerns going in there to 2026?
I think we're in a normal scenario. Normal meaning that we have real rates, real returns from cash, and real returns from bonds. Now, we haven't had that environment since really 2000. The Fed has been extremely aggressive post the tech bubble in 2000 and held rates below inflation, which led to a real estate bubble. And then post the great financial crisis, held rates again below inflation for another 10 to 12 years. So this is just normal, but we have to go back a very long ways to get back to what was normal, which was real returns out of cash and the 10-year. So the difference is that there's a much higher level of debt. And the question is now, how sustainable is that debt for the U.S.? And the real risk is that we lose control of the 10-year and we see the 10-year move towards 4.5 to 5. That'll be a more difficult environment for the U.S. if the cost of borrow rises, given the high level of debt that the U.S. currently has.
Great. And I believe that takes us on to how does obviously interest rates, what does that mean for the equity markets? You just mentioned as well the debt level rising. How does that affect currency? So talk to us about some of this equity market rotation that we've seen really over the past few weeks, but also since the beginning of 2025.
Right. So the graph on the right is showing the S&P versus the Morgan Stanley EFA index, which is a developed market index. And that is from 2009 till today. So it's been a 15 to 16-year run of the US outperforming international markets. Just in the last year, we seem to be having the largest outperformance by international markets, one of the largest outperformances we've seen in 16 years. Now, the US market has been led largely by strong technology firms, faster growth, and much higher margins here in the US. And in particular, Europe has not been as strong in terms of growth. And even today, its policies, its growth outlook, and its positioning, especially vis-a-vis the cost of energy and its dependence on foreign sources for energy, don't place it in a good scenario going forward, especially against the US in terms of growth. So right now, we're seeing some movement away from the US. We're seeing some selling of the US dollar, though I'd mentioned that it's at the 10-year average. So it's not as extreme as a sell-off as some have mentioned, given that we were at about 25-year highs just 2 or 3 years ago for the dollar. So again, it's kind of back to a normal setting for the dollar. And I think right now, for the US, it really depends on how the tech, the AI, and how the tech and the AI piece grow and what kind of margins we attach to some of those firms.
Great. We'll talk about tech. We'll talk about AI in just a second. But one question on this here, Arun, does this mean U.S. markets are weak? Should we be interpreting that way, or is this more of this is a natural progression? You mentioned new normal effectively. Can you kind of give us a little bit more insight
Right.
on the U.S. markets there?
So the US market overall, I wouldn't describe as weak, but there are two factors to consider. One is the market is expensive. So the multiple is around 22 on the forward PE. That's almost as expensive as the 1999-2000 bubble. So we are due for some kind of correction or at least a sideways movement so we can reset the multiple to a more normal level. The second part is we have the highest concentration in the S&P in more than 50 years, where the top 10 stocks are close to 40% of the index. So you really have to be careful in layering how investors look at the market, given the concentration and given the valuation, which means you could have the market struggle or correct based on just the performance of 10 stocks and have the underlying market be much stronger. So I think you're going to see a lot of divergences, and investors have to really focus on their strategy and what the exposure is to the overall 500 and how they're exposed to the Mag 7 or the top 10 names in the 500, which are 40% of the weight, very close to 40%.
Yeah, well, and with that being said, let's take a look at that specific sector. How does that really affect? What should we be looking at from AI disruption fears, valuation pressures? How should we be interpreting the software sector specifically, as that does represent, as you mentioned, a big chunk of the markets as a whole?
So it's interesting because what we're seeing today in the last 2 or 3 weeks has certainly accelerated as a very aggressive sell-off of software firms. Now, we had some firms that were impacted by AI previously, and those were names like online education firms, some of the imaging and photographic firms, and some of the call center type of firms that were the first ones to be impacted by AI. Now we're seeing AI negatively impact public software companies. So names like Adobe and Salesforce have seen their multiples contract dramatically. Adobe is around 12 times earning its cheapest basically ever. And the disconnect here is that the analysts on Wall Street, which is the graph on the left-hand side, is the analyst expectations for earnings for the 25, 26, 27 fiscal years. There have been no cuts in earnings from the overall analysts on Wall Street. They're actually raising estimates for Salesforce.
Oh.
So there's a tremendous disconnect right now between what the investors and the market is doing to these software stocks and what the analysts on Wall Street perceive as their earnings growth and their earnings moat, if you will, going forward. So this is definitely an issue that has to be resolved in the next, few months going forward. But I think there's, again, a lot of different nuances in the models of software firms, and they're not all going to be as dramatically negatively impacted by AI, I think, as what the market is viewing them today.
Great. And that just leads me to the last question here is what does that mean for the bottom line for portfolio positioning? How should we be interpreting that? How should we take that moving forward, given that there does seem to be a little bit more of that disconnect with the markets?
So it should produce a little more opportunity for either active management or stock picking, given that we're seeing some fairly large dislocations. If we have a correction, again, it's driven by that Meg 7 or by the concentration, it may not impact some of the smaller names in the 500. We are seeing a rotation as well into smaller names and mid-cap names and into some of the dividend paying companies and some of the dividend aristocrats. So we're seeing a little bit of a more aggressive style rotation underneath the market. So I think you're going to see more rotation and more active trading within the market and possibly underneath the market, assuming if the concentration still stays as it is at that overall mega cap level in the 500.
Great. Thank you for that, Arun. Well, just wrapping up then today, just a few takeaways, 5 key takeaways from wrapping up today. First, we did have a strong U.S. growth backdrop, and it's mostly favorable policies that we've seen, and that means expansion does have legs. Second, the Fed is positioned for measured rate cuts through 2025, not necessarily aggressive rate cuts, but that would signal trouble and more of a gradual normalization. Third, inflation is moderating or seems to be moderating, and rates are stabilizing at sustainable levels. Fourth, market opportunities are broadening beyond just the U.S. mega caps that we've seen over the past few years, reading into international emerging markets, which do deserve some attention. And fifth, there are selective opportunities in software amid some of the volatility, but we don't want to make sure that we're letting that narrative kind of get to us moving forward on that side. Bottom line is, this is an environment where being selective and diversified matters more than ever. And that's really about it. So that includes our monthly market recap for January 2026. Thank you for watching. Arun, thank you very much. Please feel free to reach out. If you have any questions, reach out to your advisor. If not, reach out to info@blackpointcp.com or visit the website blackpointcp.com. And thank you very much for your time. Thank you very much.